For decades, traditional economic theory treated us like perfectly efficient calculators. The assumption was that we always weigh our options with cold logic to maximize our own financial benefit. But actual market history tells a different story. In a crisis, that logical foundation collapses. Instead of calculating utility, we act like panicked animals. We are driven by a cycle of buying high out of greed and selling low out of fear, reacting erratically to every dip in the market. This behavior is why researchers Daniel Kahneman and Amos Tversky developed behavioral finance. They realized that our financial choices are governed more by psychological biases than by mathematical proofs. A library of financial knowledge is useless if an investor lacks the psychological tools to handle sudden market volatility. Success in the markets is not a spreadsheet problem. It is an emotional endurance test that requires a high degree of psychological agility. When your portfolio drops, your body doesn't see numbers on a screen. It sees a threat to your survival. Your nervous system initiates a fight or flight response, flooding your system with cortisol. This surge shuts down logical thinking. Your prefrontal cortex goes quiet, and your amygdala takes over. This creates trap 1, loss aversion. The pain of losing $1,000 is twice as intense as gaining it. We overreact to the downside. Trap 2 is herd behavior. When we are uncertain, our survival instinct is to copy the crowd. This drive to follow the group is what fuels speculative bubbles and mass market panics. This chart shows the third trap, anchoring. We fixate on a stock's all-time high price, using that historical peak as a permanent reference point. This completely warps our ability to see its actual value today. While these biological reactions once helped us survive in the wild, they lead directly to ruin in modern financial markets. To manage this biological response, we have to understand the specific psychological programming that determines our unique triggers. These are called money scripts. They are subconscious beliefs formed in childhood that act as the invisible blueprint for how we handle money as adults. As this diagram illustrates, these scripts create a financial comfort zone that limits choices. A script of money vigilance compels an investor to hoard cash. The irony is, hoarding cash guarantees a silent loss, as inflation destroys the wealth they're protecting. Actively identifying these childhood money scripts is the only way to stop the biological hijack before it starts. We can manage our biology by developing emotional intelligence. As pioneered by Daniel Goleman, this is a learnable skill that allows us to regulate our emotional responses to financial stress. The first tool is somatic regulation. By practicing coherent breathing, slowing your breath to about 6 cycles per minute, you can physically restore your vagal tone and lower your cortisol. You must perform this physiological reset to bring your rational brain back online before you make a reactionary trade. Second, you must rewrite your scripts. Identify the hidden fears driving anxiety and replace them with empowering narratives. This helps you stay the course. Third, utilize automation. Willpower is a biological failure point. We need behavioral nudges to bypass our own impulses. This diagram shows how automated investments remove the stress of decision-making. By diverting funds directly from your income to your portfolio, you bypass the anxiety of market timing and the biological pull of instant gratification. The goal here isn't to be a perfectly rational machine. That is an impossible and exhausting standard. True wealth is built by embracing reasonable strategies that you can emotionally tolerate. By identifying your scripts and automating your plan, you stop fighting your biology and start surviving the long game.